Howdy, Jacob here. Today we're looking at the Buckle. All right, specialty retail industry, 2.0 billion market cap on $1.7 billion enterprise value. Business growth is very light. We see 1.1 billion 10 years ago to 1.3 billion. But return on invested capital looks absolutely fantastic at 40%. That's good for them. They have been paying a dividend for the last 10 years. It looks like Eh, pretty, yeah, outside of COVID, pretty good increases there. Earnings per share up a little bit. That's good. Earnings per share up greater than revenue, so that's also good. Balance sheet, we see that they have about 273 million in very liquid assets. No long-term debt, no short-term debt, but 215 million in capital leases. Cash flow, great. Their cash from operations, fantastic compared to their capital expenditures. Company that's gushing out cash flow. I love it. They pay a lot in dividends and a little bit of reinvesting. So to me, is that the right thing with such a great market? It's the thing about return on invested capital being as high as it is. It's tough sometimes for companies to find opportunities to invest in. So although they have the ability to reinvest at these high rates from history, they just don't have the opportunities to make those investments to get those types of returns. So that's what's a little bit tough. So when you see companies that just buy back shares, that can also inflate it. And then paying out a dividend is tough when the return on invested capital is so high. But again, they just might not have those abilities to, or those places to reinvest in. But you still want to give a premium because there is that opportunity that if they do find something to invest in, there's a good chance money comes back very quickly. So I think I'm ready to make some assumptions here. I think it's a initial look is great company. I would say that revenue, I wouldn't be surprised if we grow at 3%. I'll put a little terminal PE of 15 and price free cash flow of 15 because I think it deserves a little bit excess than just the 13 I usually do for a 3% revenue growth businesses. I think that maybe the growth isn't necessarily market, but I think their PE and price free cash flow should be with market due to the fact that if they do find things to invest in, they'll very likely do a great job. Margins, let's do 15, 17. Have the margin increase? Okay. So operating margin 22% to 24%, gross margin 44 to 50. I might bump these up one more percent. And then for share change, maybe 1% a year. But they do have a dividend of $1.40, and that payout is $200 million is pretty high. So I'll probably cut off 25% and then stick with that. Because if you cut off 25%, you're looking at about 150 million payout, and I think that's reasonable-ish to me. So with those assumptions, the stock price needs to fall 20% before you get a 15% return with these assumptions. I think the company's great. I mean, when you have a company that's return on invested capital is that high, obviously, best case, they reinvest it to try to get those rates of returns. But you're looking at a business that gushes out free cash flow, great margins, and they're improving. Revenue growth isn't fantastic, but that's fine. You don't need a company that's going to grow immensely because with their moat status and return on invested capital, there's a good chance that although revenue might grow 2%, their earnings per share could grow 5-6% a year. And so I think it's a great company. It's just not quite at the price I'm looking for. So I'll do some more research if it gets closer, but for now I'm just waiting. Thank you.